Alrighty, folks, if you are watching the series with Taylor from Life Goal Investments, you know we just had a conversation about what to do when the stock market is overvalued. And the answer, just so you know, is don't short the market. You get your face ripped off. But it is about balancing your portfolio, moving from chips here to there. But I actually read an article that I was going to set Taylor up for. What are you ready for this, Taylor?
Well, I'm not gonna lie, I'm a little nervous because I have no idea what's coming right now. He gave me the punchline, but didn't give me what the underlying data is. So this is coming right off the cuff. Let's do it.
All right. So there was an article I read because I knew we were talking today. It says one bull market indicator that is 15 for 15 back to 1950. So 73 years, pretty good track record, right? 15 for 15, not a horrible batting average. Or, are you at least curious at this point?
15 is a reasonable number to look at,
not
right?
Two for
that's
two,
not one or
right?
two, right?
Yeah,
so
exactly.
What is it? Because I don't know, and you're gonna put me on the spot. So let's do this.
So here we go. The S&P 500, after notching a 52-week high, after having 1 year between 52-year highs, which we just had, on average goes on to run 17%.
Okay. Repeat it one more time, please.
So from peak to peak, 52-week high for the S&P 500. If it is greater than a year, which we just had, 15 out of 15 times since 1950, the market has gone on to rip an additional 17%.
Gotcha. So the fact that we haven't hit an all-time high in 52 weeks means from now moving forward, we are going to see a 17%.
Peak to peak, not all-time high. So take out the all-time high. We had a 52-week high greater than 52 weeks ago. We just notched one Friday.
Got it.
So the last high, yeah.
Understood. Yep, I got you now. Yeah. And
so they're saying that
out of the last 15 times that's happened, it's averaged up 17%, and every time it's been positive, clearly.
Correct.
Yep. Interesting. So I don't want to just start giving verbal diarrhea as to all the points that I could have to refute that. But I think there's some logic to that. Essentially, over time, this market has taken the ability to digest things over a year, right? So
it's been beaten up. That's what I take. I think that's the most important part, because this could be 2 or 3. This could be the .com crisis where we were down for 5 years. And then once it got back, it's like, okay, we have room to run. Right. I think you have to ask yourself, what is going on today, right? We got a risk-free rate of return that's up 500 basis points. We got this. We have an earnings. This might end up being 15 for 16. Who knows? But I thought it was an interesting article, right?
It's no, anytime you say 15 out of 15, like that's amazing.
That'll get your attention, right? Yeah.
Yeah. And I think your point is sound there, that listen, there's been a period of time where the market's got the ability to digest the economic backdrop that we're seeing. And I think that the economy continues to be relatively strong right now. And one of the easiest ways that people point to the economy is jobs. Jobs, if we're all employed, the market is doing well. The economy is doing well, I should say. And that's kind of the wisdom. I think where I see some point of differentiation on this is the fact that I look at things more in a rate of change rather than absolutes. And we've talked at length about this before. And I think most of the economic backdrop right now from a rate of change perspective seems to be slowing. And this is not being appreciated by the market, if you will, because the market has continued to go higher. The backdrop seems to have economic data continue to slow, not just here in the United States, but also overseas.
Yeah, China. Goldman Sachs just cut China's growth. That's not done lightly.
The other thing with China is that was the big outstanding question mark that people said, hey, this could revitalize the global economy, because the second largest population, India just surpassed them in population, but the second largest population in the world has now gone from COVID lockdowns to what we saw 2 years ago when we got let out of our COVID lockdowns.
Yeah, revenge travel.
Boom, we spent money into the market, right? And I think a lot of it is a cultural difference. Now, Japan is really known for their savings behavior, but China is also known for having a significantly higher savings behavior than we do. And maybe the point of this is everybody has a higher savings rate than the U.S. does, because we're spenders, baby. We're spenders, baby. But yeah, so I tend to think that there are more signs that say the economy is continuing to slow, and I think that at the end of the day, valuations, and we talked in two prior episodes about this, the valuations don't matter in the short term. It's all
No.
about momentum and the psychology of the market, which is risk on right now. But again, with a slowing economic backdrop, with interest rates that potentially could continue to go higher from here, with an earning recession that is already upon us,
Yeah.
companies seem to be really struggling to chew through this, even though on the other side, employment is really high.
Yeah. I think it was Michael Burry. I think he said this maybe a month, maybe 6 weeks ago. I think it was on Twitter. He's basically saying he's never seen a buy the dip crowd like we are currently experiencing today. And again, I think a lot of that's retail and momentum. They've been trained to buy the dip, and it's
They
hard to get
have.
a drop from there.
And it's interesting because I believe this is still the stat, and the only reason why it wouldn't be is potentially if last month surpassed it. But January of this year was the most retail buying in the stock
Yeah,
market
I
that we
read
have
that.
ever seen, which is interesting because stimulus checks are now gone, right? So I would have thought it would have been back in 2021 when everyone's coffers were full from the government paying out and everyone have a stimulus check, and the fact that they're sitting at home for the most part with better access to just sit in front of a computer and trade. But no, January, $1.5 billion a day went into the market in January. And again, maybe that was different. And last month, which we haven't seen data on, could potentially have surpassed that just based on the market ripping higher on a lot of retail spending.
Yeah, but again, it's really interesting. Again, as somebody who was on Wall Street for 10 years, somebody that, coached up, the rich families. These stats are always interesting. And again, it's people coming through data, but I thought something 15 for 15 all the way back to 1950 warranted my reading of the article. So I thought that was something that was fun.
No doubt about it. That's a cool stat to know. I'm actually going to look a little further into this as well, just to get some more context on it. Maybe I'll put something out on social media on it.
There you go. Yeah. What I was reading from this is, look, I'm wrong. This stat says I'm wrong. It's time to rip. I don't know. It's just a lot of fun. So Taylor, where can somebody find you and maybe see this rant later after you actually read the article?
Yeah. Find us at Life Goal Investments, and we're both on Instagram and on TikTok. We put out stuff daily there, trying to make financial concepts simple.
And you do an amazing job, man. Thank you so much.
You're the man, Michael. Thank you.